everyone, welcome to Foxon Media Digital. My name's Amy and today I'm joined by the Honourable Nick Sherry, who's the Chairman of the Transport Industry Pension and former Senator, as well as Nick Firzli, who's Director General of the World Pensions Council. So welcome, gentlemen. It's great to have you on the channel again.
Bonjour everyone.
Hi.
Yeah, of course, we had you both back a couple of years ago in the midst of the pandemic, so it's nice to have you back for a little reunion to find out where we are in terms of the economy, investment landscape, and look at what's happening in the ESG world. So just to sort of reflect on what we discussed a couple of years ago, would you mind just telling us, a bit about yourselves, what you've been up to since then, and where we are in terms of ESG finance these days?
Well, briefly, Amy, I've had some 36 years experience in the pension fund investment space as a fund executive, former Minister for Superannuation and Corporate Law, which has given me not just a side of pensions and investment, but also regulation, geopolitics. And just last year, as the pandemic started to end and we opened up in Australia, I was made chair of the Transport Fund in Australia. So refocusing on an enormous number of new issues as a consequence mainly of COVID and in the Ukraine war.
Fantastic. And Nick, would you mind just giving us a bit of background about yourself as well?
Yeah, so my name is Nick Firzli. I'm the Director General of the World Pensions Council, which is a Paris-based think tank and asset owners association. And I'm also the co-founder and director of the EU ASEAN Center at the Singapore Economic Forum. And I'm delighted to join you today for that TSAM wrap-up of future ESG trends. And it's true that actually time flies. Time flies because I think, we had an interview with you guys, I think it was around January, February of 2020. So actually it was 3 years ago. And I think Nick and I made what was then a fairly bold prediction. And I think we said that the crisis would act as the great accelerator for ESG finance. And I think it was a spot on, in all modesty, it was a spot on forecast. And it even went, I think, beyond our forecast. So actually the acceleration accelerated beyond anything imaginable today. So we are precisely, let's say, 3 years now later, because of geoeconomics. So geopolitics, finance, a lot of things happened, and it prompted that massive acceleration, both at the level of asset owners. So asset owners, who are they? Typically, it's large pension funds, sovereign wealth funds, central banks, endowments, insurance companies. These are the asset owners. Then in the middle, so to speak, you have the asset managers, the fund managers. And then at the very end, you have financial markets, right? And listed on financial markets, you have corporates. So the companies which issue bonds and stocks, shares. And all, Nick and I call it, the ESG chain or the corporate governance chain. It's very important to understand you have like these three players, and you also have governments and regulators, and that the whole change was completely revolutionized in the past 2-3 years. And it's really amazing to see now, not only in the West, but even in Asia, quote unquote, because some people, in Britain or Europe, they think that emerging markets are behind the curve. It's not true. In many instances, for the first time in human history, you have many domains, many fields where emerging markets are actually ahead of the curve, and they're more developed and more sophisticated very often than their peers in Germany or America. And yesterday night, just a few hours ago, European time, Petronas, the giant Malaysian oil and gas conglomerate, acquired the biggest solar farms in Australia, including future investment pipelines for gigantic solar farms in Australia, which were owned by German investors. And the German investors realized that in this day and age, they didn't have enough money, enough resources. And so they sold it to an Asian, Middle Eastern oil company. And that's saying a lot. A lot of these deals are happening. And on the front page of the Wall Street Journal these days, you see more often Saudi, Emirati, Malaysian giants sovereign funds or corporates than your typical, Wall Street or City of London tycoons. So these days, the Wall Street tycoons and the City of London giants are being replaced kind of by big public pension funds and sovereign wealth funds. And I think all that has contributed to that great ESG finance acceleration.
I think what's interesting is, notwithstanding COVID and the economic impact and the Ukraine war, and we've seen very significant disruption in energy markets, particularly those linked to coal, oil, gas. And I think a reality that they will play an ongoing role, but eventually diminishing role in the global energy market. Notwithstanding this short-term hiatus, the shift in community, the shift in particularly pension funds, government regulation, has continued its focus on ESG in a whole range of areas. Obviously, the adoption of pricing mechanisms, depending on a country's particular political, socio-economic structure, much more closer scrutiny, regulation, a greater focus on greenwashing, so-called, but the focus on ESG, and I always stress all three components, unremitting, inevitable, and continuing.
Yeah, we've touched on a lot of themes there, from ESG to the activity with the tech race in Asia, and as you mentioned, the energy crisis. So what does this mean for UK and APAC investors? Are we out of the woods here in the UK, and do you think that a lot of these evolving changes will speed up, or will they continue to accelerate?
I think what's been interesting about the Ukraine war in particular, we're seeing a readjustment of energy and the purchase of energy, a realignment, if you like. Obviously, Russia has massive energy resources. Europe reducing that dependency. I mean, there are practical challenges, and it will take time, but reducing that dependency and shifting its focus into alternative energy sources other than Russia. And at the same time, interestingly, pragmatically, China, India in particular, picking up their energy allocation from Russia. So that realignment's going on. But I think it's raised the awareness of energy vulnerability, particularly in Europe, and the need to accelerate the move towards ESG. And Nick has highlighted the alternatives, solar and wind in particular. There's a much stronger focus. This will take time, but it's accelerated.
And what does this mean?
The other quick aspect, of course, is it's not just energy issues, food security. They're all interwound, and we're seeing a shift in markets and alignment in that area as well.
Yeah, you actually dove into, I was leading into that point actually, because on that note, what does that mean for agribusiness, forestry, the food chain? It all plays into one, as you say, when we think about sustainable investments and food security affecting us right now.
Well, again, a greater focus on look at forestry, timber supplies for building, food security. I think one of the great disruptions is not just finding alternative, reliable sources, but also becoming more conscious of your own security. So, in one sense, a bit of a retreat from globalization and looking at trying to become more sustainable, self-sustainable within a country or within a region. I'm a bit sceptical that will happen. But certainly a greater focus on those that sustainability, self-sufficiency, if you like.
And which regional markets will offer the most opportunities in these areas then? What do you think will benefit the global economy and, investors who are looking to reallocate their assets and thinking about what will help them gain stability?
Well, where are the areas of greatest economic growth? It's still in Asia. I mean, it's a huge area. Their economies, the developing economies, yes, they've had a low period, but that growth from not just China, Vietnam, India, Indonesia still continues to outpace the rest of the world. Growth in the US, Europe, the traditional Western economies is modest. It's modest. So that ongoing focus on the Asian developing economies will continue.
I'm aware of time. So just to wrap up that segment, our colleagues at the IMF literally 4 days ago published a great report, 300 pages, and I spent part of the weekend reading it, and it's full of very interesting data. And one of the things you can infer from the most recent, IMF data, because the reason why that report was published a little late this year is because China reopened, and it took everyone by surprise. So right before Christmas, they reopened. It was a big shock to the world, and it was a bit messy. It looked a bit messy at first. And so all these, supranational economists in Paris and Washington, D.C., they've had to rejig their macroeconomic projection model for economic growth this year. So anyway, so the most recent data, freshly produced by the IMF, are really fascinating, because what they're saying is that this year, economic growth in most European countries, including Britain, will be at zero. So 0.1, 0.2, or minus 0.5 in the UK. And when you have inflation running at 6, 7, 8% per annum, if you're growing by 0% or 0.1%, it's really horrible. And what's fascinating from the IMF data is they are saying now, after revising their figures, that China alone in the year 2023 will account for 27, 28% of world GDP growth. India alone will account for 17, 18% of world GDP growth. Add to that Singapore, Australia, Asia, Malaysia, Indonesia. So clearly, more than ever in history, the engine of economic growth is the Asia Pacific area. And of course, investors in London, Berlin, New York, they will chase that future growth, because of course, future growth is really what you want if you are investing in the long term, in the long haul. And pension funds and sovereign funds are long-term investors, so they naturally chase future growth opportunities.
And just to note on Europe, I mean, Europe has clearly been the most disrupted as a consequence of the Ukraine war because of the energy connection, and it's now trying to, and it is disconnecting, but that takes time.
Yeah, and we'll actually be touching more on the reopening of China at the Summit for Wealth Management on the 9th of May in London, where Ed Smith, who is the co-chief investment officer at Rathbone Brothers, just took part in an interview on our channel. It came out a couple of days ago, and he'll be taking in a panel on the global trends happening there. So I'm sure we'll have a lot more economic analysis on the channel and at our summits. And of course, as you mentioned earlier, Nick, we've got TWUSuper ESG taking place in New York in April, as well as in London in November. So unfortunately, we don't have much time left, but I'm excited to explore a lot of these themes with you and our fellow speakers in the coming months and see where we're at. But for now, closing thoughts, what are your projections for the next 12 months, and what do you hope to see?
Look, I think solid global economic growth driven by Asia, China, India. We shouldn't forget the countries like Indonesia and Vietnam. Europe's subdued because of the energy issues around the Ukraine war. It's more directly impacted. Food prices disruption. For countries like Australia, the US, Canada, which are energy exporters, food exporters, modest growth, ongoing focus on ESG, it's not going away. the issues are being highlighted on transitioning from the coal, oil and gas, but it will be a gradual process towards new investment in areas like wind, solar, etc. And that's driven by government, it's driven by community attitudes, it's driven by the pension funds, which hold much of the collective assets. That will continue. It's an inevitable trend, whether, of course, it occurs at the pace that satisfies everyone, but I've got no doubt that will continue.
And Nick, do you have anything to add to that?
Well, I'm aware of time, and it was a great interview. I would like, if possible, to allocate our last, 3-4 minutes on an issue that Nick and I often discussed in the past 3-4 years, and it's really coming to the fore now in the early weeks of 2023. It's what we call, the age of geoeconomics. So what does it mean, the age of geoeconomics? It's the idea that the Chinese-American tech race is accelerating like never before. And some experts inside the US government, and what's really interesting, it's inside both the Republican Party, which now controls Congress, so the House of Representatives is controlled now by right-wing Republicans, but even within most, sort of intellectual think tankers, experts within the State Department and the National Security Agency and the Democratic Party itself. So it's a bipartisan issue. It's one of the only issues where Biden and the Republican right can actually agree on something. It's the idea that the race with China is accelerating, and many experts now in Washington, D.C. even call it Cold War II. So really, that age of geoeconomics, Sino-American technology race is before our very eyes at this very moment, morphing into Cold War II, and it's having great implications on the world of finance. Not only the tech sector, so not only fiber optics or microchip foundries. Of course, we're seeing it in the tech sector, but we're seeing it across the board. And my personal opinion is that in the coming quarters, in financial markets across the globe, both developed and developing, from London to Lesotho, really, many investors will be caught in the crossfire between these two giants. Will be caught in the crossfire between Beijing on the one hand and Washington on the other hand, and they will need to rejig their portfolios. They will need to take that new risk into account in the way they invest. The world will never be the same. It's becoming more and more polarized. And I think, Australia, for example, small countries, I'm saying small in terms of population, not in terms of intellectual brilliance, but mid-size, what we call mid-size economies, like Israel, like Canada, like Australia, they are used to that more than the others because, they've been used to these Cold War confrontations more than the others. So I think these countries, Singapore, Australia, Israel, Canada, are probably ahead of the curve in adapting to that new age of geoeconomics. Ironically, and I'll hand the mic to Nick, they're also ahead of the curve in one very important field of finance, which is investing in private equity, venture capital, and infrastructure. The guys in Toronto, Montreal, Melbourne, Sydney are really experts in that field, right, Nick?
Absolutely. But the ongoing tension, look, China is the second largest economic power in the world. With an increase in economic growth and power comes political, economic, military assertiveness, vis-a-vis the world's other great power, which is obviously the US. That ongoing tension, I think, is going to continue for the foreseeable future. I don't necessarily agree with some of the Chinese assertiveness, and some of Australia's had particular challenges and issues, but it's a reality. It is a reality, and how we adjust to that, Australia, certainly the new government, has tried to refocus, improve the relations. Interestingly, not on the basis of shared values, but on the basis of shared interests, and that is a common challenge that many countries like Australia will face It's not going to go away as a global issue. It will underline fundamental economic and political discourse ups and downs for at least the next decade.
I know we have to close because our time is limited, but I agree fully with what the Honourable Nick Shea just said, and I think it's the pragmatic view, and it's the right thing to do. The risk we have right now in America and Europe and Britain is that many policymakers are becoming ideological, and so they're moving away from the pragmatic center, and it's what people, including me, call the Biden doctrine. And that Biden doctrine, the problem is it's a form of neo-Wilsonianism. So what does it mean, neo-Wilsonianism? It means it's putting ideology first before interest. And it's saying, we want a values-based world. And if people don't share fully 100% our Anglo-Saxon, liberal, whatever, Jeffersonian values, we cannot trade with them. We cannot invest in their countries. And that position is potentially fraught with many dangers because it will make the world more polarized. And we don't need that. We need to try to cool down and to make the world, less polarized, less antagonized. And I think if we in the West, in Washington, D.C., London, Brussels, if we speak like that, about exporting our beautiful, ideal Jeffersonian values, it's all nice, but it will antagonize many people in the global South. And in the global South, they view it as neocolonialism. We don't want that. Of course, we want to stand for our, democratic principles, but we should do it smartly and softly, not in an aggressive way. So that would be my message of caution.
Well, thank you both for that. I think, as you say, if this is going to be an ongoing issue, we should have you back on the channel in a year or two to see if we've got a value-based system or an interest-based system and how the geo-economic situation is panning out and where we are with the US and China. So thanks so much for joining us today. I know we've had to cram a lot in, but it's been a pleasure.
Yes.
My pleasure.
Bye-bye.
And thanks everyone for watching. Don't forget to follow our YouTube channel for more content on challenges and opportunities in asset management, wealth management and ESG. And don't forget to give this interview a thumbs up and hit the subscribe button.